No matter what, you could automate something and you think it's emotionalist, it won't be because there'll be tweaks that you need to apply and then some you wish you applied. There's emotion in anything when it comes to being right or wrong or making money or not. Now, every time you get a rally in anything, you're going to put yourself in a position to miss it. You're going to miss some rallies, but you could rest assured, even if you didn't miss it, most people missed it. One of the reasons why the price of anything goes up a lot is because a lot of people missed it, meaning a lot of people didn't get long for the rally. One of the reasons why it went up. Why is that? Because if a lot of people got long, that means a lot of people would have to sell to get out of that long position. And if a lot of people have to sell, that keeps price from going up, and away. Look at it in real estate sometimes, right? If you're into a subdivision early, then there's a chance there isn't a lot of people that want to turn around and sell it and flip it. The way that analogy works is if you're going to buy a house and turn around and sell it, because most people stay in their houses a while. But if you're one of these flippers and you're going to 6 months later put it on the market, if there's a lot of people in that subdivision doing what you're doing, it's harder to get like more out of your house because a lot of for sale signs are going to go up. A lot of, guys are going to come in, remodel, put it back on the market. That means a lot of people are long, these investors, they do the remodeling, boom, then they turn to what? Sellers. If you have too many of them in a subdivision, that's competition. Too many houses that are similar in the same neighborhood, all for sale, buyers have options. Point is, in a market, take a look at this. One of the reasons why it goes up, because a lot of people missed getting long. Don't let that get you short, is the point I'm trying to make. A lot of people do the opposite to make themselves feel better. So you're imagining it long, so now you try to get short and catch the downside. That's not a good reason to be bearish if that's your only reason. Okay? You got to let those people get kind of flushed out because everyone's picking a top. So if you look at this, if you want to pick a top and you want to get short, let the other people do it and get stuck on the way up. Meaning you got, a lot of people picking the top right here. Boom, they get flushed out on this pop right in here. And now maybe you're on the other side of that blow off top, as they call it. And you want to wait and not try to be perfect and pick the exact top. You can't try to be perfect. Let everybody else try to be perfect. But when you see for the first time these pink triangles, which are showing you sell imbalances of not people who sold it, by the way, it's people who want to sell it. That's what you need for a profitable short trade to be profitable. You need people who want to sell it, not people who sold it just yet, because then they're done. Then they go back to the sidelines. If they want to sell it and haven't and still have to or want to, that's what you want for the price to have a better chance to keep going down. The triangles are people who want to sell it, and there's more of them than people who what want to buy it. So you see where they get to right in there, they show up for the first time in this huge rally. The other thing is our laser, that's this green line sticking out. It's also over here. That's also showing you there are more longs than shorts over the last 2 minutes. Sample size. Why is that important if you want the price to go down? Because what are longs? Like we just said earlier, they're future sellers. It's like a bunch of people bought a house on this block to renovate it. What are they? They're future sellers. After they do the renovations, house is going up on the market. That's what you're trying to predict when you trade or invest. Future buyers and sellers. That's ultimately what you need to accurately predict price. I mean, our end goal when we trade or invest is we're predicting where we think price is going to be in 2 days, 2 seconds, 2 years, what have you. So the point is, where are these future buyers or sellers going to come from? They're going to come from positions being offsides. All right. An offside of positions then leads to an offside of sellers versus buyers. So not only do you get more sellers than buyers in our triangle, but you're going to get this blue guy, which is a buy side imbalance. They get breached. You got our laser green, which means there's more longs than shorts. And you get this. And you get this. Meaning you get the downside. This is not random anymore. Anytime you think it's going to go down because you see this, and then it does go down, you're going to feel good, but in a genuine way. You're not going to feel good because you feel like you got lucky. That's a different feeling. You know what I'm saying? Anybody who is skilled feels good because you're stripping the randomness out. If you're playing baseball and you're really not good, and every time you get a hit, it's because you got lucky, you know that. But when you're getting your hits because, you know, you worked on your swing, you're seeing the ball well, you're waiting for your pitch, and you're making good contact, that's a different feeling in getting a base hit than hitting a little blooper and you're still on first base. It's a different feeling when you get on first base because you're lucky versus good. And when people make predictions in trading or investing and they're lucky, they're not going to be around for a long time. Their luck will run out. You have to have probabilities that stack. And so you're not surprised when you're right. If you're excited when you're right, that's not going to last. It can't be random because it just isn't. You can't build size. If you can't build confidence, you can't build size. And so you can't feel like you made a good guess or that you got lucky. You have to be able to say, I stack probabilities because we literally see an imbalance of real sellers and real buyers. And right around the last traded price, there's an imbalance, pink triangle. And sample size of us identifying longs and shorts show more longs and shorts. Everybody who is long is a future seller. And you know how I could prove that? Just look at the orders that go in after you get long. Most of people that watch these videos probably have automatic orders that go in after you open up a long position. What are those orders? OCO. It's a sell order above and it's a sell stop below. Both sell orders, aren't they? That's the way you prove it. Every long equals a future seller. All right? Future seller. That's why there's a saying I had a long time ago. After you buy it, you're a seller. After you sell it, you're a buyer. Meaning, if you open a position long, you're a seller. All right? You hope to sell it higher, but you're still willing to sell it lower if you have to. Now, not everybody has the automatic sell orders that go in after they open a long position. But if you have these, strategy runners and everything else, a lot of people do, it's proof right there that you're a future seller. And if you don't have future sellers that outweigh future buyers, then the price is not going to go down. And this is what people think is a bonus. It's not a bonus. It's necessary. It's not important to have more sellers than buyers to go down. It's imperative. All right. Well, this is going to help the bread rise. No, it's going to make the bread rise. If you're looking for a cooking analogy, it's not helpful. It's necessary to have more sellers than buyers for the price of anything to go down. Now, more sellers who want to sell it is more important than people who already sold it. That's another point of confusion for many people. And not just people who start trading, people who've been trading for a while don't clearly understand it like they should. People who sold it, well, they sold it. They're done. They go to they're no longer participating. And sometimes it's like, man, we lost a good seller there to help facilitate downside. So people who already sold it essentially aren't really as important. And guess what? What if they sold it? You see big selling come in, okay, all in here. They sold it. What if they sold it to open up a short position? Now it's actually bad to see selling come in that gets filled because what do shorts become? Future buyers. So when you're short and you see people sell it and get filled, sometimes you're like, shit, we're wasting some good sellers. And what if those sell orders are opening up short positions? Now I've got company. Now I've got competition. And when you're short, you don't want competition. All right? Get out of your own head. Early days, maybe some that have been trading for a while, if you were sitting in a conference room listening to people talk about trading and they said, when you're short, you want a lot of people short, right? Most people say, yes, more shorts, more shorts, more shorts. They would chant. You could get people to chant more shorts. It's the opposite. More shorts equal more competition because now they're buyers with you. Do you want a lot of people buying, for crying out loud? No. You want less shorts. Here's what you want: more longs when you're short, because more longs equal future sellers, which is the necessary component, the price of anything to go down. Now we have a sample size that's following longs and shorts. If you knew all the short time frame traders, longs and shorts, you literally could put the mouse on the floor and trade with your feet. And I've always joked about that. You think you literally could do that if you knew 90% of the short time frame traders' positions. And it's not the ones that, like on sim, you have to have real positions. The reason why it's not important, I shouldn't say it, but it's not as valuable to find where sim longs and shorts are, simulated trading, it's because those guys aren't necessarily, they put on a short and then they get bored and they left. They don't have to cover it. It's sim. So you get a lot of this. It's just, you get a lot of fake positions that aren't serious. And so then a short, yeah, technically he's a future buyer, right? But if he just gets fed up, it's fake. He turns his machines off and everything else because the short went against him and he kept selling it all the way up. You get what I'm saying. You have to have your sample size of longs and shorts be real orders. Could be in the micro ES, but it has to count. It has to count. And it has to have the real elements of making or losing money to be the most help. All right. So there we are. And there you have it. If you want to be random, then you won't be consistent. So you're looking to pick a top and you want to get short. Don't try to be perfect. Wait for, in this case, pink triangles, green laser, breach of the blue. It's no coincidence that once we slid through this blue here, it got momentum. There was some invisible selling meaning sell market orders that were jumping on it, filled in this buy imbalance, and it ran prices lower. Know like crazy why price moves before you try to predict where price is going. Know why the hell it moves in the first place.